The latest jobs report has just been released, and it confirms something many Americans already feel in their daily lives. The U.S. labor market is not booming, and it is not collapsing either. Instead, it is stuck in a frozen state. This is one of the most dangerous conditions for an economy, because uncertainty spreads across workers, businesses, investors, and policymakers at the same time right now. Companies are slowing down hiring, but they are also slowing down layoffs. That may sound stable on the surface, but in reality, it signals hesitation. When businesses stop making bold decisions, economic growth begins to stall. This is exactly the phase the U.S. labor market has entered in December. The U.S. economy added approximately 50,000 jobs. This number came in well below expectations. Economists were forecasting closer to 73,000 new jobs, but the actual figure missed that target by a wide margin. While 50,000 jobs is not disastrous on its own, it is not enough to support a growing population and an expanding workforce. When we zoom out and look at the broader trend, the slowdown becomes even more obvious. Job creation has been weakening for months. Earlier in the economic cycle, the U.S. was adding hundreds of thousands of jobs each month. Today, those gains are fading. This steady decline is one of the main reasons the Federal Reserve has already begun cutting interest rates. The Federal Reserve understands that high interest rates put pressure on businesses. When borrowing becomes expensive, companies delay expansion, slow hiring, and reduce investment. In a labor market that is already weakening, keeping rates too high for too long can push the economy into a deeper slowdown. Now, let's talk about unemployment. According to the official report, the unemployment rate fell from 4.6% to 4.4%. On paper, this looks like a positive development. Lower unemployment usually signals strength. However, the reality is more complex. Many Americans have stopped looking for work altogether and are no longer counted in the labor force. Others are working part-time jobs even though they want full-time employment. Some are working multiple jobs just to keep up with rising living costs. These realities are not fully captured in the headline. Unemployment number. This is why relying solely on official statistics can be misleading. The government uses standardized methods, but these methods often lag behind real-world conditions. Still, the narrative matters. Markets react to the data that is published. The Federal Reserve bases its decisions on these reports, not on personal experiences. Another critical issue in this jobs report is data revision. In October, the government initially reported that the economy lost about 105,000 jobs. Later, that number was revised sharply downward. The updated data showed job losses closer to 173,000. That is not a small adjustment. That is a massive difference. November's numbers were also revised downward. This pattern raises serious questions about how reliable the initial reports really are. When early data consistently looks better than later revisions, it creates false confidence in the economy. Because of this history, many analysts are skeptical of December's reported job gains. If past trends continue, these numbers may also be revised lower in the months ahead. What appears stable today may look far weaker tomorrow. Now, let's discuss wages. The report shows that wages are growing at an annual rate of 3.8%. This is an improvement from the previous month, and higher wages are always welcome. People earning more money is generally a good sign. However, wage growth must be compared to inflation. Current inflation estimates are around 6%. This means that even though wages are rising, purchasing power is still falling. Americans are earning more dollars, but those dollars buy less than they did before. This erosion of purchasing power has serious long-term consequences. The cost of housing, food, healthcare, and insurance continues to rise faster than incomes. Over time, this squeezes the middle class and increases financial stress across the economy. Now let's connect this jobs report to Federal Reserve policy. The Fed's next meeting is scheduled for January 28th. Before this report was released, markets estimated roughly a 14% chance that the Fed would cut interest rates at that meeting. After the report, that probability dropped to around 5%. The reason is simple. The jobs report was not terrible. If job losses had surged or unemployment had spiked, the Fed would likely step in to support the economy. But because conditions appear weak yet stable, the Fed sees no urgency to act. Looking ahead to March, expectations for rate cuts have also declined. Markets now believe there is a high chance the Fed will keep interest rates unchanged at the March meeting as well. As long as unemployment remains steady, the Fed is likely to remain patient. However, short-term reports do not tell the whole story. According to the Challenger report, employers announced approximately 1.2 million job cuts over the past year. This represents a sharp increase compared to the year before. Warehousing experienced heavy losses due to changes in supply chains and consumer behavior. Technology and automation sectors saw significant cuts driven by artificial intelligence and overhiring during previous boom years. Government employment also declined sharply, with hundreds of thousands of positions eliminated. There is some positive news. In December, employers announced plans to hire approximately 10,500 workers. This number was higher than the previous month and higher than the same period last year. This supports the idea that the labor market is frozen rather than collapsing. The stock market reacted to the jobs report with mild optimism. Major indexes moved higher, but gains were limited. The S&P 500 rose modestly and reached new record levels. This highlights the real driver behind market performance. Liquidity remains the key force. The Federal Reserve continues to inject billions of dollars into the financial system. This liquidity supports asset prices even when economic fundamentals weaken. That is why markets can rise even when the labor market struggles. Finally, let's look at the Federal Reserve's own projections. The Fed expects unemployment to end the year around 4.4%, which is exactly where it is now. This suggests policymakers expect current conditions to persist. The Fed has made it clear that unemployment is the most important labor indicator for future decisions. If unemployment rises, rate cuts become more likely. If it remains stable, rate cuts will be delayed. In conclusion, the U.S. labor market is weakening, but it has not collapsed. Job growth is slow. Wage growth is not keeping up with inflation. Purchasing power continues to decline. And because the data was not disastrous, the Federal Reserve is unlikely to cut interest rates in the near term. This is an economy in limbo. And how it breaks, upward or downward, will shape the future for workers, investors, and households across America. Thank you for the support, and I wish you a very nice day.